Hello, art people. As you guys know, I talk about lessons learned from time to time. In my opinion, lessons learned is more important than news on partnership between Neo and some other company, because that part of information is on the internet and anyone can read it. Maybe I have a certain perspective to it, but lessons learned is really what I believe is like a gift in the market for us to learn and to improve. Lessons learned, in my opinion, and it could be one lessons learned. It could make a difference between being a millionaire and being bankrupt. And I had seen both of them personally. Okay, so it is a huge thing. And some of these lessons learned you might know, or you may disagree 100%, and that's okay. That's okay. But these are my observations. So please do your research and due diligence. And let's go. Let's go. 5 lessons learned. Number one. Number one is when the company's fundamentals change. Any stock you have, you can have 5 or you can have 20. The fundamentals of the company change, such as maybe a change in a division, entire division, sell off a division, for example, or buying another company or whatever. Uh, that would create tremendous volatility in the stock. It would attract a lot of people, investors and traders and everybody. And these fundamental changes could be good or bad. It really wouldn't matter. You can have bad news and you would have volatility, and you would have positive news and you would have volatility as well. In NEO's case, I truly believe that there is a new beginning for NEO, something that we did not see for a very, very long time, and that is this stability at this point moving forward, clarity, where we're going, from profitability, from deliveries, from the business model, from the competition. So that is a fundamental change, at least in our minds. And based on this, you would see this attraction. It's not because, well, we dropped the price by $2,000. No, it is because of new stage, new base. Okay, so that's the first one. When fundamentals change, huge volatility. The second one is that when the stock doubles in price, then you would have huge volatility as well. In fact, um, different people have different reaction to huge spikes in the stock. I remember what was it? Uh, what's the name of the guy? I forgot the name of the guy, but maybe I'll mention the name when I remember it. But he said, well, when the stock goes up by 10%, okay, time to take profits. You see, some people have that short span. And I'm talking about doubling the stock. And we all know that NEO doubled in a short time, relatively short time. And that really creates a question mark for a lot of people, because not every one of us is a retail investor for life. You know, some of us are there for a short trip, right? So that creates volatility, and also it attracts people who like trading, and this is where the money becomes. People get attracted to volume and money. And you look at how much money is being traded with NEO versus everybody else in its class, right? Such as Li Auto or Xpeng or Rivian or Lucid. You would see that NEO has special attention. All right, so that is the second one. The third one is that shorts, naked shorts, they don't leave the stock easily, just like retail investors don't leave the stock easily, and they become locked. And I think that what happens is there is a comfort zone with knowing the stock, knowing the fundamentals, following, having also tremendous coverage. Like for NEO, there's tremendous coverage by YouTubers, by all over the internet, that you feel you understand a lot of things and you can act certain way. For us, we like the business model, and we want to stick to it for even for 10 years, 20 years, until we see something drastic change. For shorts, they play the game of demand and supply, and this could actually explain today's activities. As when you have earnings and the stock behaves certain way, you would think that there is a certain level of attention on the stock, or whoever wants to invest in the stock already invested in, so this is the time to do something. So in other words, these guys are not don't act randomly. I mean, they know exactly what they're doing. All right. And so in fact, having these type of observations, I sense in the morning that something was going on with Neo for today, even though we know Neo has a bright future and has a great this and great that. But the question is, why would anyone sell almost 2 million shares at loss, at 2% down, when Neo had really beautiful earning report? And the answer is, well, this is where the deep pockets are. Somebody with deep pockets know exactly what they're doing. Okay, so that's the thing. You really have to understand that these guys are in control. They know exactly what they're doing. This is not random stuff. All right. So that's the third one. Shorts, naked shorts, they don't leave easily. Some of them actually could switch in the future. Some of the guys who shorted stocks, and I know some of them for Tesla, for example, they switch. All right. Not Tesla. Netflix. Netflix was an interesting article where one of the financial institutions who shorted Netflix for a very long time, they said we stopped shorting Netflix and now we are long. Okay, so they do that. So the fourth one is that retail investors can be confused in this case. Retail investors with limited experience, they can be confused as why would the stock crash 8% the day after beautiful earnings? And if the stock crashes 8%, that means there's really no hope with this thing. I mean, this is the time when it's supposed to rise, but it came down. There's a lot of confusion. At the same time, those who are doing the action, they know how you think, because it would be part of this experience that they have, and it's their business. Okay, so it becomes retail investors they can be at risk. Let's put it this way: they can be at risk of not knowing what to do. They might think, well, maybe I should sell 50%, 25%, all of it, get out. This is my time, whatever. Okay, very risky time. The fifth one is that the best action to take in cases like this is actually do nothing. You really don't want to do anything. What you need to do is understand that there are processes in the market for a stock like Neo, and Neo is not the only one, it's not the first or the last one, and that this process is applied everywhere. The activities on Neo are not invented today. You have to understand that this is part of a process. Financial institutions are actually they do short stocks, of course, and they don't short stocks when it's risky. They can even measure the risk. Is the risk 10% or 50%, 90%? They know all of that. We don't know. They have the tools, they have the capabilities, they have the experience, they have the history, they know it all, and we don't. And so in this case, the best thing to do is just basically, because you believe in the fundamentals of the company and the future of the company, is just basically just let it go and let the process play itself. So these are the points, the 5 points, 5 lessons learned that I thought to share with you guys. I'm sure you may not agree. It's fine. So anyways, that's what it is. Please do your research and due diligence, and never financial advice. Take care. Bye bye.